technology is real. Okay, it's gonna have to have its kinks worked out. There'll be versions 1.0, 2.0, 3.0. It's real. So it's gonna be here for a while, and it's gonna be up and down.
Because here we're talking about getting on board a new wave that's just starting, and you haven't, missed out. The window of this wave of security token-enabled, industry is just starting.
It really comes down to what is a blockchain and what's it for. At the end of the day, a blockchain is really a ledger. And ledgers are really good for saying what is true, what statements are true in the world. And that can be very, very useful for moving something of value from one person to another, because you have a ledger that can say, you have Bitcoin, you've given it to me, now the ledger reflects that.
I think blockchain technology and legacy finance is going to be foundational. And so if you get all of the settlement layer to be on a blockchain, if all of the securities on the New York Stock Exchange are now settled on a blockchain, whether that blockchain is a totally open public blockchain or a permissioned one, I think is also an open question. I think until and when all of that develops, I think we'll start seeing people move in the direction of kind of mass adoption of security tokens. But until that time, I think most of the secondary trading is going to take place peer-to-peer, on bulletin board style in an OTC fashion.
What blockchains are really, really good at is getting rid of centralized parties. You don't need that extra trusted third party. You already trust the issuer, but all this big mess about how things trade around, you don't need that. And that's what the beauty of this technology is.
A World Economic Forum study that the majority of respondents responded that they believe that 10% of global GDP will be on blockchain by the year 2024.
This is a really exciting time because we get to be the pioneers of something, and right now it may feel, somewhat small, but I think we're on the precipice of something great. And if you look at the context of some of the issues that have happened in the financial industry over the last couple of decades and the financial crisis, a lot of those things can be solved and a lot more transparency can be created with this innovation.
So what the beauty of security tokenization is, or what we like to call digital securities, DSOs, digital securities offerings, what the beauty of that is we can take assets that are real, have cash flows, have inherent value, and we can capture the illiquidity discount for the owners of huge volumes of assets that have to pay liabilities in the future.
There's no such thing as a security token, right? We're buying assets. So I see all these people taking notes. Write this down. The big banks are asleep, and we're about to go on an epic run because they can't even hold the shares. Go ask any of the banks. They don't even know how to hold it. If I tokenize a piece of real estate today, they don't even know how to hold that equity. They are completely flat-footed. But it has nothing to do with a security token. First of all, we call it a token. It's a share, right? It's digital, which happens to be security. We can call it whatever we want. 3, 4, 5 years from now, we're just gonna call it equity, right?
The evolution of smart contracts is what's giving that comfort to Wall Street and other issuers that are looking to bring these assets onto the chain, and also giving the comfort to regulators, to reduce frictional costs, to increase the velocity of transactions and liquidity. Regulators also don't want that to be an open free market. They want the same securities laws that apply to be applied in the new technology, and we have ways now to, via smart contracts, enforce the regulations in real time. So you can drastically reduce the compliance cost of Wall Street, which is a huge cost burden on the industry today.
And when you start to look at smart contracts and tokens, you start to see an opportunity to pay cost effectively to distribute income more frequently. Monthly versus quarterly was worth, when we did the analysis many years ago, about 6%. A 6% premium to net asset value, so it was real. So in theory, it should be able to drive down your cost of capital as an issuer.
And I would just add that we'll see a huge class of traditionally illiquid assets become liquid, and we'll continue this kind of never-ending march towards markets for everything and liquidity for everything. And we'll begin to see how those efficiencies start to play into these markets as things that have always been illiquid, only been accessible by a small set of investors, become accessible to a much larger set of investors, and see how those markets develop. A lot of assets today are not digitized, and there's two steps to get to tokenization. The first is, should we take assets that are handled on paper or physically and move them into the digital world? And then there's a next step, which is, should we tokenize them as that path to digitization? And the digitization does a lot of these things. It allows for 24/7 markets, it allows for fractionalization. And so then you have to ask, why should we actually tokenize these assets? Why should we use tokenization as the method to digitize them?
We're going to see an integration of cyber wallets into securities accounts at major Wall Street firms. What that is going to end up doing is then opening up this pool of assets so it can be made available to the token market. That's important. So both of those things are essentially gating items that are going to bring cash into the market, and that will fuel back to the internet chart probably another leg up in these markets.
I think it's really incumbent upon us in the industry to build out that venue and do it, I think, with guidance from the SEC, certainly, and CFTC and others, that they want to see a regulated token environment. And I think once that's there, and once there is viable liquidity in a secondary trading arena, I think we're going to see far more institutional players get involved.
The reason why I think decentralized platforms are important in the security token landscape is that I think it's going to be some time before we see real exchanges, bona fide exchanges that are registered and regulated operating in the security token space.
The things I am worried about are that we have a lot of exchanges out there that are not regulated at all. They are operating without any sort of regulatory overlay. They're not being regulated as money transmitters, they're not being regulated as broker-dealers, they're not ATSs, they're just online portals for the exchange of things. I don't know what they are.
And so a lot of the challenges of the industry right now are adapting the current day technology back to that older infrastructure and kind of getting back to a baseline. But what's exciting to me is once we're back at that baseline, then when we can innovate from within that framework, I think in the coming year or two, you're going to start to see a lot more innovative solutions around custodianship than just taking physical, doing cold storage, digging things in your backyard to maintain proper custody. I think you're going to start to see a lot more innovative solutions in that space.
What's really interesting about this entire sort of journey in space ultimately is that the notion of tokenization has just completely ripped apart the basics of capital markets, in the sense that prior to cryptocurrencies, any sort of capital raise was done in a geography in accordance with the laws of that geography. And now all of a sudden, through the issuance of coins, you have an access to global markets. And so what's huge about I was going to say humongous, but you took that word. What's huge about the idea that you can raise capital globally is that you're no longer sort of bound by nation state.
Yeah, with securities, the Securities Act from 1933, 1934, the Howey test from the 40s, there's all these old regulations, and we're not trying to break what these rules and regulations are. We're trying to, how do we fit and comply with these regulations within the new token economy?
Going back to this concept of freely tradable securities, this is a big part of tokenizing securities, tokenizing assets, wanting to be able to have this liquidity, being able to trade them 24/7 on these digital markets. So Reg D and Reg S both have holding restrictions, and Reg CF for that matter. So for the most part, those securities are going to be locked up for a year, and you're not going to be able to trade them.
I think what you have to remember is that in 10 years, everything that you could do in traditional securities markets, you'll be able to do in these markets. This is the beginning, This is a little bit more of a decentralized way to issue capital. It includes less middleman, it includes more automation, which means lower legal fees, lower accounting fees, lower tax bills. And it takes the power away a little bit from the traditional institutions at the moment, but in 10 years, this will be the norm.